Welcome back to ShareTreck, everyone. I'm Jack, and with me today is Diane, and we're going to be taking a look at something that's been in the news quite a bit lately, and that is the bond market shift.
Yeah, and we're both investors here, and, I think this is something that can have a big impact on everybody's portfolios.
Yeah, we want to make sure that everybody understands what's going on out there, and particularly what it means for them as investors.
Absolutely.
So let's, kind of set the stage here a little bit.
Okay.
We've been seeing some headlines talking about, U.S. 10-year Treasury yield going above 5%. I think it was just yesterday. It was 5 point something.
Yeah, 5.25.
Yeah. So for folks that don't follow the bond market every single day,
Right.
why is that significant? Why should we care?
Well, you have to remember, for years we've been in an environment of historically low interest rates.
Right.
And those near zero rates that we saw not too long ago made borrowing money very inexpensive and fueled a lot of growth.
Uh-huh.
But it also pushed investors into riskier assets
Yeah.
in search of higher returns.
Makes sense.
Now, as yields climb, and we're seeing this globally, not just in the U.S., it signals a fundamental shift.
So it's like the ground is shifting beneath our feet a little bit.
In a way. Yeah, I think that's a good way to put it.
Yeah. So what's driving this surge? Is it just something happening here in the U.S. or there's something bigger at play?
Well, it's definitely not just a U.S. phenomenon.
Yep.
Globally, yields are rising. Look at the U.K., you can look at Japan, even the emerging markets are all seeing upward pressure on yields.
So this suggests that it's not just a domestic issue, it's really more of a global.
Absolutely.
Okay.
It suggests a broader change in investor sentiment, a growing concern about risk and inflation.
So it's almost like the whole world is waking up to a new reality where borrowing is more expensive and maybe those, high-flying growth stocks aren't as attractive as they once were.
Exactly.
Okay, so let's drill down into this a little bit. What are some of the factors contributing to this global shift?
Well, first, the U.S. economy is stronger than many expected. We've seen solid job growth, and that's making the Federal Reserve less likely to cut interest rates anytime soon.
So higher interest rates for longer, which isn't necessarily a good thing.
It does make things a bit more challenging,
Yeah.
especially for those who have gotten used to cheap credit.
Right.
And then there's the elephant in the room, U.S. government debt.
Okay, yeah. Can't ignore that. How does U.S. debt play into this bond yield surge?
Well, the U.S. has been running massive deficits for years.
Right.
And to finance that debt, the government has to issue more and more bonds.
Makes sense.
When the supply of bonds goes up, it can put downward pressure on prices,
Okay.
which pushes yields higher.
So it's a classic supply and demand issue. The more they need to sell, the higher the yield they have to offer to get buyers.
Precisely.
Got it.
And we're talking some serious numbers here. The Congressional Budget Office is projecting the U.S. deficit will exceed 6% of GDP in 2025.
Wow.
That's a lot of borrowing, and it's making investors nervous.
Yeah, that makes sense. And that brings us back to those bond vigilantes that we always hear about. Aren't they the ones who are kind of spooked by all this government debt?
They are indeed.
Okay.
Bond vigilantes are investors who basically try to discipline governments that they believe are borrowing too much.
Okay.
And they do this by demanding higher yields on those bonds, making it more expensive for the government to borrow. Think of it like a risk premium.
So it's like they're saying, hey, Uncle Sam, if you're going to keep racking up all this debt, you're going to have to pay us more to lend you the money.
Exactly.
Interesting. Okay, so we've got this global shift in sentiment, stronger than expected U.S. economy, a mountain of U.S. debt, all pushing bond yields higher. What does this mean for us as investors? Where do we even begin to make sense of all this?
Well, that's the million-dollar question, isn't it? And unfortunately, there's no easy answer, but let's start by looking at some of the potential impacts. One of the most immediate is the rising cost of borrowing.
Yeah, we're all seeing that right now, higher mortgage rates, car loans, even credit card interest. It all adds up.
Exactly. And for businesses, it means higher costs for capital, which could slow down investment and economic growth.
Right.
Then there's the potential impact on the stock market.
Okay.
Historically, a sharp rise in bond yields has sometimes signaled trouble for stocks.
Yeah, because why take on the risk in the stock market if you can get a decent return in something that's considered safer, like bonds?
Exactly.
Makes sense.
And it's worth noting that in the past, big jumps in bond yields have preceded stock market corrections. I'm not saying that's going to happen now.
Right.
But it's something investors need to be mindful of.
Yeah, for sure. I mean, we're not trying to scare anybody, but it's important to at least be aware of the risks.
Absolutely no one has a crystal ball.
Hmm.
But understanding these historical patterns can help us make more informed decisions.
Okay, so we've got rising borrowing costs, potential stock market, jitters, a whole lot of uncertainty. Where do we go from here? What are the possible scenarios for how this bond market shift might play out?
Well, there are a few different scenarios that analysts are considering. One is what they're calling the higher for longer scenario.
Okay.
This suggests that we've entered a new era where bond yields will remain structurally higher than they've been in recent years.
So no more cheap money fueling those high valuations we've gotten used to.
That's the idea. They point to things like, deglobalization, demographic trends, and the need for increased government spending on things like infrastructure and climate change initiatives as reasons why this might be the case.
So these aren't just temporary headwinds. We're talking more long-term structural changes that could keep upward pressure on yields for the foreseeable future.
That's the argument. And if this scenario plays out, it would require investors to adjust their expectations for returns on bonds.
Okay.
Those days of super low yields might be gone for good.
Which could have a big impact on asset allocation decisions, right? If bonds are offering higher yields, maybe they become more attractive compared to stocks, especially for folks that are, looking for income and stability.
Exactly. It's all about recalibrating your portfolio to align with this new reality.
Okay, so higher for longer is one scenario. What's another possibility? Is there a chance that this is just a temporary blip and yields could come back down?
There's always that possibility. Some analysts believe that once the current economic uncertainties subside, yields could come back down.
Okay.
Their argument hinges on the idea that the Fed might eventually pivot back to rate cuts, which could send yields lower.
So in that scenario, investors that hold on to their bonds might actually see some price appreciation as yields fall.
That's right. But as always, it's important to remember that predicting market movements is incredibly difficult. No one has a crystal ball.
Right. Nobody knows for sure, but at least understanding these different scenarios can help us, prepare for various possibilities.
Absolutely. Knowledge is power.
Yeah.
And speaking of knowledge, let's not forget the potential for increased volatility in this new environment. As we've seen, bond markets can be quite volatile, especially during times of uncertainty. Investors need to be prepared for some potential swings in bond prices.
Yeah, nobody likes to see their, investments bouncing around like a roller coaster.
Right. It's enough to make you want to bury your money in the backyard.
Exactly.
Tempting, but probably not the best strategy. This is where having a well-diversified portfolio comes into play.
So you're talking about the classic, don't put all your eggs in one basket approach.
Exactly. It's crucial to spread your investments across different asset classes, stocks, bonds, maybe even some alternative investments to mitigate risk.
Okay, so diversification is really our best defense against the potential volatility of this bond market shift.
It's one of the most important tools in our arsenal, and it's not just about what you invest in, but also how you manage those investments.
Got it. Okay, so we've talked about the drivers of the bond market, shift, the potential impacts on investors, the different scenarios that might unfold as we look ahead. What are some key things that investors should be watching out for in the coming months to kind of navigate this new landscape effectively?
Well, a few things stand out. First and foremost, keep a close eye on inflation data.
Okay.
If inflation remains stubbornly high, it will likely force the Fed to keep interest rates elevated, which would put a lid on any potential decline in bond yields.
So inflation's still the big monster lurking in the shadows.
It's definitely a key factor driving monetary policy decisions globally. And speaking of the Fed, investors should also pay close attention to their communications and actions.
Okay.
Any hints about future rate hikes or cuts could have a significant impact on bond yields.
Sounds like it's going to be a nail-biting few months watching those Fed meetings and economic reports.
It does require a bit of vigilance, and let's not forget the global economic landscape. Keep an eye on developments in major economies like China and Europe. Any signs of a slowdown could have spillover effects on U.S. bond markets.
So we need to stay informed about what's happening, not just in our backyard, but around the world, really. It's all interconnected.
Exactly. It's all part of being a savvy investor in today's complex world.
Speaking of savvy investors, we always love hearing from our listeners. What are your thoughts on this whole bond market shift? What questions do you have for us, Diane?
Yeah, what's catching your attention in all of this? Are you more concerned about the rising borrowing costs, stock market volatility, or maybe that growing U.S. debt? Share your thoughts and concerns in the comments, and we're here to have a conversation.
Exactly. And while you're at it, don't forget to like this review and subscribe to ShareTreck. It really helps us grow our community and reach more investors like you.
All right, back to the bond market. We talked about a lot of risks and uncertainties, but are there any potential opportunities for investors in this new environment?
Yeah, is there a silver lining to this cloud?
Well, as we discussed, higher yields do mean that bonds are now offering more attractive returns than they have in recent years.
Okay.
So for investors who are looking for income bonds, could actually be a good option right now.
So it's not all doom and gloom for bond investors.
And not at all. It's just a matter of adjusting your expectations and strategies to this new reality.
Okay, I want to go back to this idea that we might be at the end of a multi-decade bond bull market before we move on to some listener questions.
Yeah.
It's certainly a significant concept to consider. I mean, for decades, investors have grown accustomed to falling bond yields, which has driven up bond prices. But if we're now entering a bond bear market, that trend could reverse.
Absolutely. And that would have major implications for anyone holding bonds.
So for folks that are listening that are holding bonds, what would you advise them to do?
First and foremost, don't panic. Remember that market cycles are a natural part of investing.
Yeah, okay.
What goes up must eventually come down and vice versa.
Right.
The key is to have a long-term perspective and manage your portfolio accordingly.
So don't make any rash decisions based on short-term market movements.
Exactly. If you're worried about the potential for falling bond prices, you might consider shortening the maturity of your bond holdings.
Well,
That way, you'll be less exposed to price fluctuations if interest rates continue to rise.
makes sense. And as always, it's wise to consult with a financial advisor who can assess your individual situation and help you make informed decisions.
A qualified financial advisor can provide invaluable guidance as you navigate these complex market dynamics.
All right, I think we've covered the bond market shift quite thoroughly now.
It's important to remember that historically the stock market has trended upwards over time, despite periods of volatility.
So stay the course and don't panic.
Exactly. And as always, if you're unsure about what to do, it's a good idea to talk to a financial advisor who can provide personalized guidance based on your individual circumstances.
Great advice, Diane.
Well,
Well, I think we've covered the bond market shift pretty thoroughly today. What are some key takeaways you want our listeners to walk away with?
the main takeaway, I think, is that the bond market is in a period of significant transition. We're moving away from an era of ultra-low interest rates to a new environment where yields are likely to be higher for longer. This has implications for everyone, no matter your age or risk tolerance.
So buckle up, it could be a bumpy ride.
Perhaps, but remember, with knowledge and preparation, you can navigate these changes successfully.
Couldn't have said it better myself. Diane, thanks for joining us today.
My pleasure.
And thanks to all of our listeners for tuning in to ShareTreck for this review of the bond market. Be sure to check out the show notes for links to some of the resources that we talked about today. And if you enjoyed this review, please like and subscribe to the channel. It really does help us out. And be sure to leave a comment. We love hearing from our listeners, and we'll do our best to answer any questions you might have. Until next time, happy investing, everyone.